Hey DLA markets, what's up? This is Greg, and this is your Fed update. Okay, so you probably know by now, because it's the day after, that the Fed met and basically raised the Fed funds target 0.75% yesterday. Along with that, Chairman Powell came out and gave his spiel for an interminable amount of time. Actually, I literally fell asleep while I was watching it. Very difficult to watch his entire presentation, but there are a number of quite dramatic implications to what they're doing, and more specifically and more to the point, what they are not doing or what they haven't done. Now, I have spoken on this subject many times on the channel, where I have stated for about a year that the Fed was enormously behind the curve with respect to inflation. And I've talked extensively about the insane money printing and also the irresponsible fiscal policy coming out of the federal government, which has basically gotten us to this point. Okay, so this 0.75 increase, which we saw, was really an accommodation and a reaction to the market, in the sense that they have been saying, first they were saying 0.25 forever, then they were saying 0.5 forever, and responding to pressure from the market, they finally came to the conclusion that they had to do 0.75, okay? So what you're seeing here is you're seeing a reactive Fed. You're not seeing a Fed that is really taking charge and really doing what needs to be done to crush inflation. All right. So with this 0.75 increase, you have a Fed target right now of between 1.5 and 1.75. When you have inflation as measured by the CPI, which we all know is a cooked number, right? We know that this is not a real number. This is a fabrication that the government has come out with, but the government's telling us it's 8.6%. I believe the real number is 15 to 20% if you look at what it costs to fill your tank, heat your house, or eat. Of course, if you don't eat or do any of those things, you're in good shape. But if you do any of those things, it's closer to 15 to 20%. All right, so everyone's getting crushed. The middle class is literally getting destroyed over this. The politicians are freaking out. Biden's going crazy with all kinds of crazy ideas and insane speeches that basically are lies, for lack of a better word. He's blaming everybody else except himself for all these insane policies he's put forth. But leaving that aside for a second, there are a couple other data points that I want you to be aware of, and they're not, these statistics are not as much in the forefront as the Fed funds rise is. So I just want to mention them to you. First, retail sales was down, or fell basically 0.3% this past month. That is a decline from 0.9 to 0.7. In terms of the growth in retail sales. So retail sales is slowing down vis-a-vis April. That's a May number. And so you're seeing demand destruction in the economy based on this incredibly high inflation rate that we have. Okay, so you're already seeing the demand side begin to collapse. And we've talked a lot about that on this channel. I direct you to some of my other videos in the past. In addition to that, housing. Okay, housing is responding to the increase in mortgage rates. Mortgage rates are around 6% now, the 30-year rate. The government Fannie Mae fake rate is a little bit lower, but the real rates that banks are putting out there and things like that are over 6% on the 30-year. Okay, this is a dramatic increase, okay? Because only a year ago, rates were like 3.5%, 4%, right? This has a dramatic effect on the housing market, okay? And it's basically going to crush the housing market. I'm probably going to do a video just dedicated to the housing market because I know there's a lot of interest in that, okay? This is going to literally crush the housing market. The other thing that I want you to focus on, which I mentioned in the last video, is that consumer sentiment hit an all-time low of 50. Okay, and this sentiment index is an enormous harbinger of a potential downturn and a potential recession. Okay, I believe that a recession is a virtual certainty, and I think that the rise in interest rates, the rise in the treasury yields, and the inflation that we're seeing is going to have a continued negative impact on the stock market. And you're seeing that today. The market was down the Dow was down between 600 and 700 points at the time I'm making this video. And that's following a brief rally yesterday, which I think was a relief rally, because they were worried, I think, that the Fed would wimp out and only do 50 basis points, but they did 75. So there was a brief rally there in the form of a relief rally. Okay, so where does this all leave us? Okay, because we are investors and we want to be in a position where we understand what's happening to us in the market and basically where to go from here or how to manage our risk going forward. Okay, so just to summarize where we are, you have, and I use the government's numbers, okay, you have an 8.6% inflation rate, the highest since the 1970s, okay. You have a Fed that is completely behind the curve. And actually, I was thinking today I'm going to have to come up with another term other than behind the curve, because I've said that over and over and over again. Maybe out to lunch, on another planet, completely clueless. I don't know. I'll come up with something. But I have to come up with another term just to make it more interesting. But anyway, Fed massively behind the curve. You have a worldwide energy crisis, okay? And you have governments, and front and center is the U.S. government that doesn't have the slightest clue as to what to do, okay? Rather than, jawboning the energy crisis issue and talking about we're going to open up oil and gas and sitting down with Chevron and Exxon and figuring out how we're going to get this done and how we're going to get some more permits approved and how we're going to start the drilling. All Biden would have to do is just say shit like that, and I'm telling you, oil would go down to 90 in like a day. But they're too ideologically invested in killing the oil and gas business. That was his stated policy, and if you don't believe it, go back and look at some of his campaign speeches and the debates. I've seen recently some of the old debates where he literally said he's going to kill the oil and gas business. He's going to end the oil and gas business in favor of renewable energy. He literally said that as a campaign slogan. So he was true to his promise. He's implementing what he said, and as a result, we have an energy crisis in the United States, and we have a worldwide energy crisis all over the world. You have a horrible geopolitical situation, which we've talked about extensively. The war in Ukraine is not going away. All of these forces are conspiring to create an ugly situation with respect to inflation, combined with the supply distortions related to shipping and things of this nature. So you have all these exogenous factors that are influencing us here. And really the only tool that the Fed has at its disposal is to increase interest rates and to reduce its balance sheet, right? Known as quantitative tightening. It will continue to do that. It will continue to, because it has to, right? They have a dual mandate. They only have two objectives, right? One is a 2% inflation environment, and the other is full employment. Okay, those are the only two things that they're supposed to be doing. That's their mission in life, right? And they're failing at both measures. I mean, unemployment is very low in the mid to high threes, but they're failing miserably at their main objective, which is controlling inflation. So they have to do this. They have to crush the economy, right? Because the only thing they have control over is the demand side. The supply side, they have no control over, okay? The supply side of the economy, they have no control over. So their only tool left for them is to crush the economy. Now, when this happens, and I already believe that we're in a recession, the stock market will continue to go down. In general, I would not buy the dip here, but I've said in past videos that I think you can be a stock picker if you know the companies, if you're picking companies that have very long histories of growing their earnings, like Google, for example. That was one of the ones that I like on the growth side. Exxon and Chevron, I love on the commodity side. So for companies like that, I think you can still be a stock picker. But for the market in general, we're at the early stages of what is going to be a horrendous economic situation and horrendous continued geopolitical situation, and as a result, a horrendous situation for the markets. So I would say in general, don't buy the dip. It's too early. A lot of people are going to do it. You're going to see rallies, bear market rallies, but don't get fooled. Use it as an opportunity to sell your losers. Raise cash and be liquid, because when the VIX hits 40 to 50, it was up to 80 in the financial crisis, okay? 80 it hit before the market bottomed. So keep an eye on that VIX, and until you see this massive capitulation and the market wrings out every single remaining vestige of bullishness and there is blood in the street, you will not have the base formed for the market to go back into a bull market mode, and you're not going to get that until the Fed eases credit again. Okay, as long as the Fed is tightening, as long as the Fed is raising interest rates, we're going to be in a bear market. Okay, don't fight the Fed. That's like the most important thing I could ever, impart to you. Do not fight the Fed, and don't fight the interest rate trends. Okay, well, that's my update for today. Sorry it's more negative news, but we got to be realistic here. I don't even consider this negative. I consider it realistic. We have to be realistic. The Fed's going to continue these 75 basis point at least rises in the Fed funds rate, and the bond market, as it stops printing money and stops buying securities, the bond market is going to take care of the rest and look to intermediate to the long end of the curve increasing in yield until we hit a very strong inflation and you see massive demand destruction. Then you're going to see the bond yields moderate and possibly the stock market rather form a base where it can then go up from there. Okay, well, I hope you got value out of this. If you did, please like and subscribe. I'd love to have you on board in the channel. We talk about the stock market, we talk about the general markets, we talk about the economy, we talk about economics, and the sole goal of the channel is to make you a better and hopefully richer investor. All right, thanks again for watching, and we'll see you on the next video.